Hello everybody. Welcome to our channel, where we bring you the latest insights and strategies for financial success. In today's video, we will be discussing how most people can invest now to potentially get rich in the anticipated 2024 stock market crash, with wisdom from the legendary investor, Warren Buffett. But before we dive into that, make sure you hit that subscribe button and ring the notification bell, so you never miss out on our valuable content. Now, let's get started. Imagine a future where the stock market is experiencing a significant crash in 2024. While many investors panic and lose their hard-earned money, there's a select group of individuals who not only survive but thrive during this challenging time. How did they do it? Today, we will uncover the strategies that Warren Buffett suggests for most people to potentially get rich in the 2024 stock market crash. Warren Buffett is the chairman and CEO of Berkshire Hathaway, a conglomerate that owns many businesses and invests in many stocks. He has a net worth of over $100 billion, making him one of the richest people in the world. He is also known for his wisdom and generosity, as he has pledged to give away most of his fortune to charity. Buffett has been investing for more than 70 years, and he has seen many market crashes and recessions. He has also learned many lessons and strategies that have helped him achieve consistent and extraordinary returns. Warren Buffett's first principle is diversification. By spreading your investments across different asset classes, such as stocks, bonds, and other assets, you reduce the risk of any single investment negatively impacting your overall portfolio. This way, if one sector or industry experiences a downturn, your other investments can potentially offset those losses. The second principle is value investing. During a market crash, many stocks become undervalued due to panic selling. By carefully analyzing companies and investing in those with solid financials and long-term growth potential, you can position yourself to benefit when the market eventually recovers. For the average person, Warren Buffett suggests focusing on low-cost index funds or exchange-traded funds, ETFs, that provide broad market exposure. These funds offer instant diversification and are a cost-effective way to invest in a wide range of stocks or bonds. Additionally, individuals can research and identify individual companies that align with their investment criteria and have the potential for long-term growth. Think long-term. Buffett says that investing is not about getting rich quickly, but about building wealth gradually. He advises investors to buy stocks that they are willing to hold for at least 10 years, and not to worry about short-term fluctuations or news. He says that the stock market is a voting machine in the short run, but a weighing machine in the long run. This means that the market price may not reflect the true value of a company in the short term, but it will eventually catch up with its fundamentals in the long term. Therefore, investors should focus on the intrinsic value of a company, not its market price. Understand the underlying business before buying a stock. Buffett says that investors should not buy stocks based on hype, rumors, or charts, but based on their knowledge and analysis of the underlying business. He says that investors should only buy stocks that they understand and can explain in simple terms. He also says that investors should look for businesses that have durable competitive advantages, meaning that they have something that makes them superior to their competitors and protects them from losing market share or profitability. Some examples of competitive advantages are strong brands, loyal customers, economies of scale, patents, or network effects. Invest in wonderful companies at a fair price. Buffett says that it is better to buy a wonderful company at a fair price than a fair company at a wonderful price. This means that investors should not chase cheap stocks that have poor quality or growth prospects, but rather look for quality stocks that have reasonable valuations. Buffett says that wonderful companies are those that have high returns on equity, consistent earnings growth, low debt, and excellent management. He also says that a fair price is one that is below the intrinsic value of the company, which can be estimated by using various methods such as discounted cash flow analysis or multiples comparison. Be fearful when others are greedy and greedy when others are fearful. Buffett says that one of the keys to successful investing is to be contrarian, meaning to go against the crowd and do the opposite of what most people are doing. He says that investors should be fearful when others are greedy and greedy when others are fearful. This means that investors should avoid buying stocks when they are overpriced and overhyped, and instead look for bargains when they are underpriced and underappreciated. Buffett says that market crashes and recessions are great opportunities to buy quality stocks at low prices, as long as investors have done their homework and have enough cash to take advantage of them. Reinvest your dividends and compound your returns. Buffett says that one of the secrets to his wealth is compounding, which is the process of earning interest on interest or returns on returns over time. He says that compounding is like a snowball effect. The more money you have, the more money you make, and the longer you let it grow, the bigger it gets. He advises investors to reinvest their dividends into more shares of the same or other quality stocks, rather than spend them or keep them in cash. He also advises investors to reinvest their capital gains when they sell their stocks at a profit, rather than pay taxes on them or spend them. Learn from your mistakes and improve your skills. Buffett says that investing is not easy, and everyone makes mistakes along the way. He says that investors should not be discouraged by their losses or failures, but rather learn from them and improve their skills. He says that investors should keep a journal of their investment decisions and outcomes, and review them periodically to identify their strengths and weaknesses. He also says that investors should read books, articles, reports, and newsletters to expand their knowledge and stay updated on the market trends and developments. Follow your own judgment and ignore the noise. Buffett says that investors should not be influenced by the opinions or actions of others, but rather follow their own judgment and analysis. He says that investors should ignore the noise from the media, analysts, brokers, or friends who may have ulterior motives or biases. He also says that investors should not be swayed by emotions such as fear, greed, or envy, which can cloud their rationality and lead them to make poor decisions. He says that investors should have a clear investment plan and stick to it, regardless of what others say or do. Be patient and disciplined. Buffett says that patience and discipline are essential for successful investing. He says that investors should not expect to get rich overnight, but rather wait for the right opportunities to buy or sell stocks. He also says that investors should not chase hot stocks or fads, but rather stick to their investment criteria and strategy. He says that investors should not be tempted to sell their stocks prematurely or hold on to them too long, but rather follow their exit rules based on their target price or time horizon. Enjoy the process and have fun. Buffett says that investing is not only a way to make money, but also a way to have fun and express yourself. He says that investors should enjoy the process of learning, researching, analyzing, and making decisions about stocks. He also says that investors should have fun with their investments and not take them too seriously or stress over them. He says that investing is like a game, where you compete with yourself and others, and where you can win or lose. Remember, investing is a long-term game. It's crucial to stay disciplined, avoid emotional decision-making, and focus on the fundamentals of the companies you invest in. By following these principles, you can position yourself for success, even during challenging times. Thank you all for watching. If you found this video valuable, give it a thumbs up and share it with your friends. And don't forget to subscribe to our channel for more insightful content. Until next time, happy investing!